Seeing the Russell 2000 moving higher, seeing these breakouts in some small cap names, seeing the rotation of the marketplace into new sectors and new industry groups, I think is really exciting because you could have a stealth bull market, right? In the average stock, maybe the index doesn't pull out higher, and that's maybe bad news for the passive buy and hold closet indexers. But for those of us who are investing in individual securities or being a little more tactical in terms of where we put capital to work, I think there's a lot of good news happening under the hood.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Welcome, everybody, to this week's podcast. My name's Andrew Wilkinson. I thought it would be a good way to end the year and look forward to 2024 by reviewing some charts with my favorite technical analyst, Tyler Wood. Welcome back, Tyler.
Thanks, Andrew. Good to see you.
It's good to see you, mate. Tyler's back from the Chartered Market Technicians Association, or the CMT. And I think last time we did a podcast in July, Tyler, we called it, I stole a line from what you said, which is, I have some good news, explained the technical analyst. And things kind of looked up from there. So how do you see the world at this point?
You know, it's funny. I delivered that quote saying the good news was we don't have to predict the future. Technical analysis allows us to stay on the right side of trends no matter what way they are headed. And yes, we certainly have seen a healthy rally in 2023, very fair and orderly seasonal weakness in October and November. I think there was a bit more of a sentiment washout than what I was expected. But here we are, December 12th, rallying above the July highs and making a run at all-time highs from 2021.
Okay, so Tyler's given me a series of charts, and I'm going to include them in the show notes. You'll see those at ibkrpodcast.com in the episode show notes, so take a look at those to kind of view along. Let's start then, I think, Tyler, with the SPX, the S&P 500. What are you seeing there?
The thing that most people forget is that markets can move in three directions. Right? We love a binary black and white world where it's either going up or it's going down. But when you look at 3 years of market history on the S&P 500, we rallied through 2021, and that felt like a great bull market. 2022 was really quite fair and orderly retracement of a lot of those gains as we saw interest rates peak, and we'll get to that in a minute. Where we're at right now is a little bit of a confusing point. Certainly, there is a strong equity rally, and it's been led by the mega cap tech names. Growth stocks have been our leadership groups throughout this rally. And when I'm looking, at us reclaiming those highs from July and maybe making a run at all-time highs to reclaim, where we reached in 2021, that's all fine and well. I certainly root for the U.S. economy and root for the market. And I think maybe we're a little over our skis in terms of the market pricing in this expected soft landing from the Fed. But when I look at a chart like this, it doesn't scare me that potentially we, hit some resistance back at the 4750 level and tank, right? There are plenty of talking heads on financial news media predicting the end times to come in 2024. And they may be right. They're very smart people. They're looking at a lot of data sets. And I think a lot of the macro investors have been very resistant to this year's equity rally. Firstly, they point to breadth. And then they also point to the fact that the macro landscape and the lagging effect of these higher sustained rates from the Fed could really pose a drawdown on the economy that we haven't seen yet. So case in point, right? People talk about most mortgages in the U.S. locked in for 30 years at low rates. How about our Canadian counterparts? They have to refinance every 5 years. Or what about the folks that need to buy a new car? And what are those loans going to cost in terms of how that pinches the cash flow in the economy? We may not have seen the full effect of these Fed rate hikes yet, which is why they paused quite a while ago, and we've just been sustaining higher for longer. When people look at those historical corollaries, when the Fed has paused rate hikes, we've often seen market retracements and severe bear activity after the fact, right? It could be a 3 to 6 month lag.
So now the next chart we wanted to look at is the value line geometric, which I'm going to ask you to explain for the listener and for my benefit. What is the value line geometric chart all about?
Yeah, so people talk about the stock market, but it's not a stock market or just the index. It is a market of stocks. And they're in the average stock in the United States, we haven't seen a strong rally, meaning here in 2023, as the index climbed higher, the average performance has really been quite a choppy, range-bound mess. And you'll see it in that chart. From our trend models, it's re-entered, an upward trending environment in the week form. This is on a weekly basis, but we're seeing a break back to positive momentum. We're seeing it re-enter a positive trend on this value line geometric index. And like the RSP or any other vehicle you might look at to see an equally weighted performance of the average stock, this is another way of looking at that. And the point that I think I would want to make to all the listeners is that absolutely the equity index, it's nice to see that reclaiming prior highs or maybe even making a run at a breakout. But as investors, we have tons of opportunity under the hood. And all of the critics of this bull market saying that there's no breadth expansion, it's just these magnificent seven that are carrying us higher. This week we saw semiconductors breaking out to all-time highs. We saw small cap industrials breaking out to all-time highs. There's a lot happening under the hood, which doesn't necessarily equate to a new breakout in all-time highs at the index level. So the point that I want to make is, as everybody starts to think about, what's the game plan for next year, everyone's trying to predict the future about what's going to happen with the Fed and how markets will react. What I would say is, the good news is you don't have to predict a scenario for the index. And it may be another lost decade. Who knows, right? We could chop around at the index level for 10 years. But seeing the Russell 2000 moving higher, seeing these breakouts in some small cap names, seeing the rotation of the marketplace into new sectors and new industry groups, I think is really exciting. Because you could have a stealth bull market, right? In the average stock, maybe the index doesn't pull out higher, and that's maybe bad news for the passive buy and hold closet indexers. But for those of us who are investing in individual securities or being a little more tactical in terms of where we put capital to work, I think there's a lot of good news happening under the hood. And so that value line geometric index, it's not in a raging uptrend, but you'll see that we've broken back above some downward sloping trend lines. For the third time, we've re-entered trending conditions based on our model, and I just see some good news on the horizon for expanding breadth and the rotation in the market, which the great Ralph Acampora said, rotation is the lifeblood of bull markets.
Now, Tyler, we've got to back up here a little bit. We're going to talk about the 10-year Treasury yield. It's been a big year for monetary policy. The Fed seems to have stopped tightening back on November the 1st. How does the 10-year yield look chart-wise?
So, we're still a series of higher highs and higher lows. The pace of rate increases, I think, was what shocked the market. The uncertainty in 2022 of just how fast and how far. Nobody quite knew what the upside target was, and some very prominent technical analysts were calling for 5%. Well before the rest of the public even thought that was possible. When I think about 10-year Treasury yields, I like to look at a quarterly chart. It goes back to about the time that I was born, and my parents bought their first mortgage in 81, and they were paying 17% on that. So we have been in a structural downtrend for 40 years or 39 and a half years. And what started as just a reversion to the mean, back to that downward sloping trend line off the COVID lows in 2020, we've broken higher and we've sustained that upward trend. So when I look at this on a weekly basis, we're coming back to test support at around the 4.2 level. We're seeing momentum strike a little negativity, and maybe it's a pause here, which is very healthy. That's a tailwind for risk assets and for equities. But I certainly wouldn't be in the camp that would predict a return to zero interest rates or negative interest rates that they saw in Europe. I don't think we're going back there. And I'm not alone in that opinion. I think you've probably heard that from every one of your guests. Where we go,
let me ask
yeah,
you a
go,
question
please.
about that. Amidst all the panic, when yields hit 5%, was that kind of did you feel a bit of relief at that point? Do you think, this is going to create change for the market trend?
Great change for the average household, big time, and not positive change, right? We're fighting inflation and we're also constricting capital flows. So for the average household, that's not good news. But it doesn't have to be the end times for all investors. If you look back at the 1950s, and I don't put a ton of weight in historical corollaries, but you can have a bull market in a rising rate environment. There's more volatility. Maybe you need to think about shortening up your time frames for what you're holding. But a rising rate environment is inherently bullish for the economy. And I think the fear that we've spiked in rates, or that the expectation that they would be back at 1% by the end of the year is really, that's maybe short-sighted. I don't see a Fed cutting cycle that's going to begin so aggressively in the early part of next year.
Yeah, our economist Jose Torres has been referring to this period between the end of tightening and the start of cutting as a monetary policy bridge, and he's got a few things to say about that. It's kind of where you're on the bridge fishing with us right now, Tyler.
Yeah, we're going to hear from Chairman Powell tomorrow on the 13th, and we'll probably get the same kind of narrative that we've heard, which is we're sticking with these higher rates while we continue to fight towards our inflation target. Core numbers versus headline numbers, or what everybody wants to talk about. And for me, as an investor, it's important to understand the relationship between these assets. The intermarket analysis that John Murphy taught us back in the day is still really important, very valid today. But I certainly don't want to spend too much time trying to predict what the Fed's going to do. I'll just react to what comes my way.
Now, 2023 being a good year for the dollar based upon that prior conversation about rising interest rates, rising yields. We're pretty much on that monetary policy bridge. What's the implication for the dollar index on the chart?
The dollar index is a really important corollary to what happens with risk assets. And so when we can get a break in that dollar strength, it's been a good time for equity rallies, and they tend to be very strongly anti-correlated. What we've seen from 2021 over the last 3 years is this incredible strength in the U.S. dollar, and I'm going to lean on my macroeconomist friends to help explain. We're probably the dirtiest shirt or the cleanest shirt in the dirty laundry pile, right? Which is the phrase that everyone uses. I don't see a currency war coming along. I don't see China just dumping all of its U.S. debt holdings. What I think happens from here is that we're stabilizing. Right, so we peaked out in September of 22. We started to see some relief on that dollar strength, basing out through most of 2023, chopping around, which is really good for markets. Right, it doesn't actually matter so much where the level is, but when you have currency stability, I think that relieves some of the uncertainty for investors. And we had a little rally through the fall that correlated with the seasonal weakness in equity markets, and right now we're turning back up again, but we're at fairly neutral momentum. We're kind of chopping around here at this 103, 102 level, and that's not a bad spot for us to be.
Heading into year end, I've heard the expression the everything rally, and one of the ingredients there in that rally has been gold, which has perked up this year again, courtesy of inflation. What's gold looking like chart-wise?
I pulled this out on a monthly chart. I'm not the only person looking at this, right? But we have a decades-long basing pattern, from the highs in 2011 back to the rally in gold in 2020. And that huge smiley face that you see on your screen is what Louise Yamada and Ralph Acampora and Alan Shaw, like, we want to buy smiley faces. When they break out of a basing pattern that's a decade long, that could be really, really bullish. Now, for 4 years, we have been retesting that 2,100 an ounce sort of level for gold. We cannot break through it. We rallied through the end of last week, had kind of a blow off top, and we've corrected sharply this week. Here's what I would say as an investor. Every one of my econ textbooks in grad school said, yeah, gold is the flight to safety. That's the place you go in an inflationary environment to have a store of value. Well, there are alternatives in 2023 for people looking for a store of value that's perhaps not so impacted by inflation. And I think that may be one of the things that is putting this really heavy ceiling on gold breaking out above 2,100. If it does, right, and here's the scenario playing that I am comfortable with. We know that breaking above 2,100 at all-time highs, above this resistance level we've tested now 5 times going back to 2011, that's a sizable move. The investor psychology around gold, if we're breaking out to all-time highs above this resistance level that has been so heavy on gold, then I think there's a real interest from a lot of investors to being long gold, and that's just going to drive demand, which is going to drive price up. So do we continue to chop around and retest that level a few times? Potentially. Andrew, I have a young daughter who practices Taekwondo, and sometimes she has to do board breaking. And I'm not going to lie, sometimes she takes 3, 4, 5 whacks at that board before she can get through it. What we know about resistance levels is the more times they are tested, the more likely it is that they break through eventually.
Now, the final chart, this is a really good way to wrap up today's conversation, is oil, crude oil, and has significant implications. It's had a great bull market of its own. The fundamentals have lined up behind it. And then as the economy is, ripped and the Fed is trying to contain it, people seem to be looking at commodities thinking that just perhaps if there is a soft landing or heaven forbid, a hard landing, then crude oil's going to suffer. So we're back to somewhere around the $70 mark on crude oil. How does that chart play out?
So for us, looking at the trend model, we rallied a bit through the fall. We're back into no-go conditions or downtrends. We've got negative momentum. For me, that's a bullish sign for the economy, for the fight against inflation. We don't want to see oil back above $200 a barrel. That's a huge drag on a lot of small business owners, a lot of the industrial economy. But what I really like seeing through 2022 and 2023 was this stabilization, right? Oil was negative. What a crazy time we live in, Andrew. Negative pricing on barrels of oil in the depths of the pandemic. That's a logical low for what was a multi-decade or a decade-long downtrend in crude. Could that have been the low, and we pop off of that into what could be a commodities super cycle or a super duper cycle or whatever silly name you want to put on it? What commodities trends tend to look like is longer term, we see the dominance, right? Stocks over rocks or rocks over stocks. And I think if we are going to see a bull market across commodities, oil's definitely going to be participating. I think time frame really matters. So if we're talking about, what does this look like in 2030? That's a very different conversation to, do I want to be invested in oil right now? And the answer is no right now. It's in a downtrend. There's negative momentum. Crude is pulling back, and that could be bullish for the economy, for small business owners, and for industrials. But do I think crude is going back to zero? Absolutely not. And certainly it looks structurally like we've set some new highs. We've failed to reclaim those and break out again. But I would venture to guess that over the next few years, we'll continue to see commodities start to perform well against other asset classes.
What's the feeling amongst the professional crowd of CMT charter holders, those who work for investment banks and broker dealers and so on? What are you guys telling you? What's the feedback, the outlook for next year? What do they think?
It's fairly well split, which is what makes a good market, right? If everybody's on one side of the boat, it tends to tip over. And so depending on your time frame and the tools that you're using, you could come up with evidence for either scenario. But I think technical analysts as a whole would agree that where the index heads is not the most important thing. It's getting your sector bets right, making sure you can be tactical. If we're in a higher volatility regime with rates being higher, maybe we shorten up our time periods a little bit. Maybe investors, instead of holding for multi-year periods, start to look at things rotating every 6 to 9 months and paying closer attention to what those leadership groups are. We've certainly seen the rotation cycles speed up. And I think part of that has to do with the frictionless way in which people trade through ETFs and other vehicles. And we've certainly seen explosive activity in the options market, which certainly changes the tenor of market trading as well.
You mentioned small cap stocks earlier on. Why would they be breaking up now?
So when you talk about the everything rally, right? When we look at rotation and we start to see value performing better in a higher rate environment, I'm gonna use the F word here for a second, Andrew. The fundamentals of the companies, those small cap and value names start to look more attractive as people digest the fact that we might have higher rates for much longer. So the long duration growth equities that have held our market up this year maybe potentially don't look as good under that backdrop of a Fed that's not willing to start cutting. And I think, commentary from Chairman Powell tomorrow will be important, but also what they act on in the first quarter. If they are sustaining these levels, then we could see investors really start to shift their holdings and start to allocate, watch those money flows. If they are piling into those small caps, we could certainly see a massive rally under the hood that wouldn't really impact the index level. And I'm certainly rooting for an everything rally. I think it's about time to have that breadth expansion and see some new leadership emerge.
Excellent. Tyler, brilliant. Thank you very much. One final question. What's the outlook for the CMT from here? You mentioned Dubai to me earlier on. What's happening?
I'm so glad you asked. Speaking of crude oil downtrends, the Gulf region is an incredible financial powerhouse. Dubai is one of the freest cities in the world, and we opened an office in India in 2018, and there is a inextricable link between the vast and fast-growing Indian economy and the financial center in Dubai. We have members all over the world, and instead of hosting our large flagship event in New York each year, here in 2024, we are moving that to Dubai. So mark your calendars for leap year 2024. We're going to be hosting February 28th and 29th at the Crown Prince's Museum of the Future in Dubai, a wonderful seminar with some of the world's top money managers, trend followers, global macro analysts. We're really excited about what we're able to pull together. And, Dubai is sort of the crossroads of the globe. Everybody can get there with a pretty easy flight. So looking forward to that, and hopefully some of our Interactive Brokers friends will come join us.
Very good. I certainly hope so. Tyler Wood, CMT of the Chartered Market Technical Analysts Association. Thank you very much for joining me.
Thank you so much, Andrew. Happy holidays to everyone. Sending love and light. Talk to you soon.
Thanks, Tyler. Bye for now.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at ibkrpodcasts.com. And if you're interested in learning more about Interactive Brokers, visit ibkr.com. We offer more trading education material, such as webinars at ibkrwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at IBKR.com. There's a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the Characteristics and Risks of Standardized Options, or ODD, which may be accessed through the link found in the